Okay, so in this today's session, I'm going to discuss about the capital structure. Before I begin the session of the financial leverages and operating leverages, it is important to discuss about the capital structure in the corporate finance. So just take a look. The first thing is let me define what exactly is the meaning of the capital structure. See, students, capital structure in corporate finance is a mix of various forms of the external funds. So when we talk about the external funds, which commonly known as a capital, used to finance a business of any firm. So what is this? What does it consist of? It consists of shareholders' equity, preferred stocks, debt, and maybe some other external borrowings through venture capitalism, and maybe private placement of securities and other debt-based instruments. So it basically consists of the shareholders' equity, debt, and the preferred stock. So, and what is that? We can discuss with this pie chart that it has been shown here: the equity capital, the preferred stock, debt, and other sources. In other sources, as I discussed about the venture capitalist and private placement and other debt based instruments such as bonds, etc. So let's take an example here. For an example, if the company has to raise funds through capital, that is, for an example, take 100,000, in which I have taken here example like 8,000 shares have been acquired through the equity capital, 8,000, and say 20,000 through the debt-based instruments. And here I have shown like prices per share. The face value is rupee dollar 10. So fund generated by equity will be 80,000. I have mentioned here 80,000. And cost of equity, for an example, say consider 5%. And the debt has been raised $20,000. And the cost of debt considered here 10%. And of course, there will be some tax rate which will be counted so far as the WACC is concerned, weighted average cost of capital, 30%. So now just see what happens. In another way, this the WACC. So in which we cannot do the same thing like most of the students and most of the novice analysts they do, like if they consider the cost of equity 10% and the cost of debt 5% or 10. So they add the cost of equity and the cost of debt, and they say this has become the weighted average cost of capital, which is a wrong concept, because we have to consider weight also in order to form the optimal capital structure. So what is the objective of the optimal capital structure? In the optimal capital structure, it is considered that the valuation of the firm should be enhanced. The concept behind is to enhance the valuation of the firm along with the substantial decrease in the overall cost of capital, and simultaneously the WACC should come down dramatically. Substantially, it should come down. So this is a concept behind the optimal capital structure, and that is not the fixed element which is observed in any kind of the organization. This depends upon firm to firm. So as I have mentioned here, the WACC, the elements of equity, cost of equity, and the element of the cost of debt. So, in the cost of equity element, it is required to consider the systematic risk factor, which is known as beta. Beta is one of the systematic risk factors, along with the risk-free rate. And so far as the cost of debt is concerned, it is required to know the average debt yield and the tax shield also. As I mentioned here, the tax shield is 30%. So in the next session, it is due to consider the element of the WACC, then how the WACC is considered and how the WACC is calculated. But the wrong conception behind the calculation of the cost of equity and the cost of debt, as usually it happens that the cost of equity is say 5% and the cost of debt is 10%. So you just do one mistake. You add both the cost and say this has become the weighted average cost of capital. So this is a wrong concept. So just take a look another one. For an example here, I have considered the weight of the debt is, for an example, 40%. So then if I now calculate the WACC and taking the preferred stock weight is, for an example, 10%, common stock 40%, retained earnings 10%. So overall, the weights of the cost structure is 100%. But 40% belongs to debt, 10% belongs to preferred stock, 40% belong to common stock, 10% belong to retained earning. These are all examples. So the overall cost of capital will be like 5.14 plus 13.4 plus 17.1 plus 16, and then we will take the average. So this is the actual calculation of calculating the WACC. So this is another part of discussion which we'll be doing, but still it will be done before our discussion of the financial leverages and operating leverages. So we have to consider both the concept, and then we will be doing our analysis in order to find out the overall cost of goods sold and the valuation of firm, and what are other objectives of the firm, along with this only the valuation of the firm. Okay, so this is another concept which I am just keeping it now, and we will be discussing in a short while about the financial leverages.